Thursday, April 14th, 2022, Monaco 64, home of alternative economics and contrarian views. Today, we're going to look at how the seeds of hyperinflation have been planted already. And in my opinion, central bankers are helpless to stop it. Yes, there's a lot of talk now that we've peaked in inflation and that it's going to come down and that it's going to be, everything's going to be okay. And that would be very nice, of course. I'm not arguing that wouldn't be good. But the same people who are projecting this peak in inflation were the people who never saw inflation coming. And then when it did come, and by inflation, I mean the rising prices, and that's a big problem that we're going to come to in a minute, the definition of it. But then they said last year, oh, it's going to be transitory. It's not going to get over 4 or 5%. And here we are now, probably at double digits in reality, because government statistics are quite economical with the truth, I would say. They tinker a lot with the statistics. So before we go further, and I've done this many times, maybe not so much in the last year or so, but for those of you who have followed me for years, you probably know my Merriam-Webster Pocket Dictionary from the early 70s. And we're going to turn to page 365 for the definition of inflation. So here we go. And one thing I would say about economic things, yeah, stick to what's simple. The Keynesians, who have basically put us in this hole, they complicate things. They don't want the public to know the truth. So an abnormal increase in the volume of money and credit, resulting in a substantial and continuing rise in the general price level. So that definition has been changed. Nowadays, we are led to believe that it's the consequence of inflation. And what is inflation again? Well, it's when governments and central banks increase the supply of money and credit. And how do they do that? Well, by scratching each other's back. The central bank manipulates interest rates to zero. The governments buy votes with more deficit spending. When was the last time there was a budget surplus in the UK or in the US? I don't remember. Very long time ago. And yes, the commercial or private banks do create the currency, but it's the engine of government and central bank that makes it possible. And I've spoken a bit about this recently. To understand inflation, all you need to know it's that it's diluting your milk. You go somewhere for breakfast and you ask for a glass of milk, and they bring you the milk, nice good milk, and then you keep going there and you notice the milk doesn't taste the same, and they're adding water to it so it doesn't to cheat. Basically, it's cheating. They charge you for milk, but they put water in it. And that's the same thing with the currency. They add a lot of currency into the economy, not backed by real things, by real economic activity, by deficit spending, by government spending. And it makes the currency worth less. And that's what inflation is. And unfortunately now, when you look at headlines in the newspapers, Telegraph, Mail, Guardian, be it whatever side of the political aisle, I've seen many times, price of holidays drives inflation higher. No, it's the mechanism, the monetary mechanism that creates inflation. And when we have rising prices, that's the consequence of inflation. So these are the same people, the people who have told you that CPI is inflation. They're telling you now that the CPI is going to drop back. But the problem is that knowing now the definition of inflation, if you look at the balance sheet of the major central banks, and the Bank of England isn't included in here, but it would add to this. If you look since before the financial crisis, central banks around the world have increased their balance sheets from around 5 trillion to almost $32 trillion. And what does that mean? Well, how do they increase their balance sheet? Well, by creating money, or if you want to call it reserves, out of thin air. Money and credit out of thin air to buy government bonds, mortgage-backed securities. And then when you do that, it keeps interest rates low or yields low, because you buy the bonds, the price rises and the yields go down, and people can keep borrowing. So when they tell you that inflation is peaked, well, first, they're wrong, because they're talking about prices. And second, all that money and credit's still around. So the inflation is here to stay, and it's not going to get any better. And one of the reasons I'm talking about this is that I saw a tweet yesterday, and it was from the day before, by an MP, Ian Lavery, and I think he's a Labour MP. And he said, Mr. Porter, 83, and his wife, Meyer, 80, can't afford to keep themselves warm. They've switched off their heating and are wearing layers of coats to prevent the cold. At 83, Gerald is thinking about going back to work. This is happening in the 5th richest nation on the planet. Well, Mr. Lavery, he needs to realize that this nation is not rich anymore. It might be rich compared to maybe a third world country, but he doesn't get out that much. I don't think he doesn't. I guess at least he realizes Mr. Porter and his wife can't afford heating. But unfortunately, that's the consequence of inflation. And the seeds of hyperinflation are there because they're helpless, the central bankers. Our base rate in the UK, yeah, it might rise above 1% soon, but it's still below 1% and has been there since 2008. And the QE, the money printing, has been like astronomical. So all that money and credit's still there. And even if they wanted to stop the inflation, they'd have to deflate, really. They'd have to raise rates enough to destroy a lot of the bonds, a lot of the loans, and that would completely crush the economy. There would be loads of bankruptcies, government included, and the only thing surviving would be real money, gold and silver, of course, because it's outside the system, and real assets would survive, but it would be devastating. Politicians and central bankers usually like inflation, and that's why I think they're helpless. And you're going to hear a lot of people talking about Putin, about supply chains and everything else. But in my opinion, all you need to know is that the seeds of this inflation, and I think it's going to unfortunately evolve into hyperinflation. It might not get to levels that we saw in 1923 in terms of 1,000,000% or 1,000,000,000,000%, because I think the powers that be will be under more, they might be under more control. They'll impose rationing and things like that, which the Germans didn't. But you never know. It is possible to get those kinds of rates, because I think the people that do have some wealth, do have some money, they might start seeing this and they might start acting, getting rid of that currency, because hyperinflation or currency collapse, it becomes totally a loss of confidence in the currency. You don't want that currency anymore. And it happens even during an economic slowdown. That's the other thing. The Keynesians didn't think you could have a recession in the 70s and inflation, and they still think the same. It's like they never learned that lesson. Yeah, when you get a currency collapse or hyperinflation, the economy isn't doing well. It might seem like it's doing well a little bit in the beginning. And with that, I'm just going to come to the ingredients of hyperinflation, and then I'm going to refer you a couple of books that I have referred many times over that will help you understand and help me kind of see what was coming. Because I read these books over 10 years ago, maybe 15, 20 years ago, and I could see the seeds being planted. So let's go through some of the ingredients of hyperinflation, just to try to convince you that we are almost there. And I don't say this with glee. I'm not trying to sound clever. I'm just trying to help people so that they can try to protect themselves, because I don't even know what the exact consequences are going to be, but it's not going to be pretty. So number one is a debt problem. And we all know we have public, private, corporate debt that is insurmountable, really, and it's growing every day. So you need to keep that going. And so the second is the result of that, which is debt monetization. The central bank, while they call themselves independent, and they're not, because if Andrew Bailey raised rates to 10% today to really kill inflation, to deflate the system, he'd be out of a job very quickly. So yeah, debt monetization, the Bank of England is doing that, the Fed, all the Western central banks is doing that, the ECB. Social unrest, social division. Well, I don't really have to tell you what's going on socially, the division. I mean, the UK, you've had the Brexit division, pro-Brexit, anti-Brexit Remainers. In the US, you've had the left-right paradigm, Trump. In Europe, it's getting pretty bad as well. You've got the French as well, left and right. Yes, political instability and division is there. The other one is to do more with finances and markets. It's you get a lot of speculation and gambling. Well, look at cryptos. That's gambling. Look at the stock market. Look at real estate. Yes, some people buy their homes to live, and it is nice that the prices have gone up. It's actually the currency going down. But there's a lot of people out there buying many properties to buy to rent, and they think they're going to become rich because, well, the currency is collapsing and the value of the houses seem to go up. So there's a lot of that. And why is there a lot of gambling speculation? Well, because normal work, productive work doesn't pay, because wages haven't kept up with the inflation. And the other symptom, and Rafi Farber talked about that in his latest video, that even during Weimar Germany, during the 1922, they had the lowest unemployment in ages in Germany. And that was 1 year before the whole thing imploded, because it's cheap to employ labor because wages don't keep up. So capital has, the wherewithal to employ labor. The other thing that you get is conspicuous consumption, especially by the very wealthy. And you just have to look at the super yachts by the very wealthy, the artwork going for millions of dollars. You just have to look at also luxury goods. Their prices are going through the roof. You read about that restaurant in London where they put gold on the steak and you pay hundreds of pounds or thousands of pounds for a steak. I mean, these are all symptoms of that. And then I always remember reading not just When Money Dies, which is the story about the German hyperinflation, but also fiat money inflation in France, which is the hyperinflation they had in the 1790s, revolutionary France. It always starts with food prices rising. And we've seen a lot of that, and that's not going to stop. And yes, you might say, oh, it's to do with the Ukraine, but it would have happened no matter what. Another crisis would have triggered this. And it's all about the currency, because if the currency was good, we wouldn't have these problems. Producers, growers of crops, they would be willing to sell it to you for a reasonable price, but the monetary system is so unhinged, and I think they were able to keep it kind of under control up until 2020. But with all the money printing they did in 2020 all over the world, it really it was the last, the straw that broke the camel's back. So I'm fortunate that I found the Austrian School of Economics over 20 years ago. And why is that? Well, the Austrian School is the opposite of the Keynesian mainstream economics that we have. And they look more at psychology of individuals. They look at the economy as billions of people interacting, human action, and that people's actions have consequences. And they also espouse that the smaller government is, the freer markets are, the more prosperity there will be, while the Keynesians are on the other side. They think governments should be in charge. They look at econometrics, they look at numbers, equations. They think that central government can control the economy like a thermostat. And they're the people who come out with these statistics, CPI, and try to fool you into thinking, oh, there's no inflation. But now it's coming home to roost. All this Keynesian mentality, and the Keynesians always think that government should be there when the economy slows down, the business cycle slows down, by just to help kickstart the economy. The problem is that you do that many times and the economy becomes dependent on the state. And that's when the debt grows. And that's where we are right now. We are in the end game of the Keynesian world. And that's why Ian Lavery MP is so shocked, but because he's part of the system. And politicians and central bankers are not the only ones to blame. Unfortunately, the general public is to blame as well. Maybe not because they did it on purpose, but because they've trusted authority. They've trusted the politicians, the bankers, the central bankers, and they've gone along with this. And they've thought that they could have something for nothing. And unfortunately, you can't. So yes, yesterday we got the CPI numbers from the UK, which is really the consequence of inflation. It's showing that inflation hasn't been controlled. There's also the RPI number, or retail price index, which used to be the number people looked at before they created the CPI in the late 90s. And the RPI came out at 9%. So I would say it's probably even more than that, because as I said, statistics are always doctored with. The CPI itself came out at 7. So yes, we might see that number come down, like peak temporarily. But if you think about the CPI index, it's like a stock market index. So if it's at 100 and goes up to 150, 2% of 150 will be a lot bigger increase than 2% of 100. So even if we go back to 2 or 3%, it's going to be even worse than it was before when it was 2 or 3. So yeah, that's the situation we're in. And it's not just in the UK, it's everywhere around the Western world, or maybe the whole world, to be honest. With that, let's look at the markets where they are this morning. It's just before 8:30 a.m. London time. We've got spot gold at 1972. It's down about $5. High has been 1982, low 1970. Silver is up. Well, actually, it's down now. It was up when I started this video. It's down 7 cents at 25.65. The high has been 25.89. The low 25.60. Quickly on the precious metals, they look very good. The mining stocks look good as well. Yeah, I do still expect volatility in the markets, but knowing that this inflation is not going to be able to be reined in, and even if they try to rein it in, everything around them is going to collapse. Having gold and silver is a good thing, even in a collapse. In the 1930s, when there was the Great Depression, the deflationary collapse, yes, they confiscated gold in the US, but home stake mining went up 500% because it was real money. So yeah, the miners, for example, the GDX closed above 40. That was a key level. So that's encouraging there. Back to the markets here this morning. The Dow futures up 20 points, so virtually unchanged. NASDAQ futures up 32, about 0.25%. S&P is unchanged as well, up a couple of points, 4,450. The FTSE 100 index is down 12, and the Euro Stoxx 50 is up 24 points. To the currencies, and yesterday, the dollar kind of dropped. We saw sterling and the euro surprisingly rebound quite a bit. They had been trading down quite a bit for the last few weeks. So in spite of the high inflation data, or CPI and RPI data, sterling caught up quite a bit. Right now we're up 0.1% at 131.31. I think we got below 130 yesterday. So currencies are quite volatile as well. But I would say too that all these fiat currencies, I do cover them against the dollar and stuff. But against real money, gold and silver, they're on their way out. The euro is up 0.15% at 109.05. The dollar is down 0.25% versus the yen at 125.31, and the dollar is unchanged versus the yuan, 637.75. The dollar is unchanged versus the Swiss franc, 93.43. Aussie dollar is down 0.1% at 74.44. The dollar is unchanged versus the Canadian dollar, and the Kiwi dollar is actually up 0.4 at 68.18. To the general commodities, WTI crude is down 1%, but it's at 102.75, so we're back above 100. Brent crude is down 1% at 107.35. High-grade copper is up 0.1% at 4.73. And U.S. nat gas is now above 7 at 7.1060, up just under 1%. To finish off, we're going to look at the 10-year yield, see where yields are. And I noticed that the 10-year gilt yield is approaching 2%, which is quite significant, I would say. But the U.S. 10-year yield is, it has rebounded, or bond prices have rebounded. Yields have come off. We were in the 80s, like 280s. Right now we're at 267, down 2.2 basis points. And I don't think the bear market in bond prices is finished. This is just maybe a short-term counter-trend rebound in prices and drop in yields. If you enjoyed this video, make sure you hit the like button. Please share it far and wide. Think about subscribing to my channel if you haven't yet. And you can also follow me on Rumble, Twitter, Facebook, and all these other platforms below here. I wish you all a great day. Take care. Bye.